Welcome to The Owner's Exit, the podcast where business owners learn to plan smarter, exit stronger, and move forward with confidence. In each episode, you'll hear from industry experts, seasoned entrepreneurs, and owners who've successfully navigated their exit. Together, we'll unpack the real stories and proven strategies beyond smooth, successful transitions, and share practical advice for your own exit planning journey. So if you're a founder, entrepreneur, or business owner thinking about what's next, you're in the right place. This is the Owner's Exit Podcast, where we help owners see to, through, and beyond the sale of their business. Tina McGill, she is the founder and head CPA of MMAS CPAs. She specializes in accounting and advisory services for healthcare professionals and business owners nationwide. Within the healthcare space, they like to work with folks in the eye care, dental, and dermatology spaces. They offer services full back office support, from full back office support to CFO level advisory services. Tina's known, and I've witnessed firsthand, she's known for meticulous attention to detail and customized financial strategies. She's passionate about helping business owners build value, avoid tax pitfalls, and exit wisely. She brings a strategic and numbers-focused mindset to all of her relationships, and she prides herself on that. So, Tina, thanks for making the drive up. Thanks for sitting down with us.
I'm so excited to be here.
Yeah.
So thank you so much. Like you said, I have some unique perspective, managing partner of Mass CPA. So we really focus, we've helped clients navigate over $40 million in acquisition revenue in the past 5 years. And I think something unique about us is we bring kind of a strategic approach called exit without selling. And what that means, it doesn't mean you don't sell your business. It's that you're thinking about that business before you sell, right? So
thinking about the exit. Yeah.
Right. Thinking about it now, thinking about the exit, usually about 5 to 6 years prior to selling. And we find that those entrepreneurs who make that plan early are going to be obviously way more successful when this time comes. And that's really been the key for our last 5 years. We've been crazy, busy. It's been fun, seeing lots of interesting things. And I'm really excited to talk about a lot of those today and maybe how your people listening can help avoid some of the pitfalls that we see, but also start thinking about what does exit look like to them, right? If you have never thought about that, now's the time. I mean, I started thinking about exit the day I started my business. And so it's never too early, right, to start thinking about how are you going to position your business where you want it to be in the future.
Yeah, we talk a lot about how an exit plan is not, 6 months, 12 months, 18 months before you sell a business. It's making sure from the start that it's transferable and attractive at any point in time. And so I want to dive in a little bit more to this exit without selling. You mentioned 5, 6, 7 years before selling, or hopefully sooner.
Right.
You're creating this plan. So this plan, what does that include?
So I think it starts with like basic conversations right at the beginning. What are we trying to do? What do you want your business to look like? So there are multiple types of reasons to start a business, right? You love it. You're passionate about it. Usually people don't start their business because they're like, I want to sell and make a lot of money. There are a small portion of those people. But generally, we have a passion for something and we go start a business because we think we're really good at it. So that's really where we start. But then we have to say, okay, well, how does this business help me reach my goals for the future? Mm-hmm. So I think that first conversation that we usually have when we're talking with clients is, what do you want that future to look like? What is that vision board, right, that we all talk about in business? Like, how do you create your vision board? Well, what's your vision board?
I want to stop you real quick because it's so interesting as a CPA and so quantitatively focused. The first thing we're talking about here is like a qualitative vision board. I think that just speaks to the importance of it on the forefront.
Oh, for sure. Yes. You can't have quantitative without qualitative.
Yeah.
I mean, honestly. So if we don't know where we want to go, and I think that's when you talk with your CPA, one of the biggest downfalls is that you only rely on them, right? Entrepreneurs only rely on them for numbers. They don't talk about these things with their CPA or their financial advisor sometimes, right? Like we miss out on these key components of why are we doing what we're doing? And
yeah, that's, I mean, you raise an interesting point because what I've found a lot of business owners, or the relationships that they have with their CPA, everything is always like past tense. It's like, this is what I have done. What can we do? Versus what can we do? That needs to be the first question because you can structure things differently, and rather than having, it's like a forward focus versus a rear focus. Does that make sense?
yeah, exactly. So when I kind of came from a unique background because I started as a CFO and then went into public accounting. So I did not follow the Big Four path. So when I came into public accounting, the first thing I noticed is that it was reactive, right? My client was calling me 2 months later and saying, oh, I just bought this piece of equipment, or, oh, somebody called me and said that they wanted to buy my business and I've signed it LOI. I'm like, well, you've done what? Wait, what? What are we doing here?
And an LOI is?
Letter of intent, right?
Yes.
So when a business, someone approaches you, the first thing they do is have you sign a letter of intent so that you guys can start the conversation around the sale, right?
Right.
So as part of that process, they would come after the fact. Well, there is so much that needs to happen way before that conversation occurs. Mm-hmm. So that's when I was like, we're doing something wrong in the industry. And it's not necessarily that we don't have the capacity as advisors, but we have not taught our clients to rely on us as their trusted advisor. We talk about that as the industry. We talk about how we want you to come to us, but we haven't opened those doors, right? And part of that is CPAs are so busy, we're understaffed. So when we're having those conversations, it's like, what do you need? Okay, and move on. Mm-hmm. So when we started Mass CPA, one of the things we really try to do is to stop that, right? To say, no, we're going to align with our clients in a way that's strategic, that's really a part of who they are. We become part of their business because then they can rely on us. And when we're starting those conversations, the first thing we do is say, what is your vision board? What is your dream? Why? What is your why? Where do you want to be? And so when they start talking about that, sometimes it's as simple as, I just love what I do. I don't have a plan. I know that I think it's going to be worth something though. So how do I make it worth more?
Yeah.
Because we know that 80% of entrepreneurs have their business. That's 80% of their net worth, right?
It's tied to their business.
Tied to their business. So if we look at that and we have 80% of that net worth tied to the business and we're grinding for years and years and years and we get to the end, we get this letter of intent and it's 60% below what we expected.
Yeah.
How are we going to exit successfully? So having those real conversations with clients, because what we find is clients think they're worth about 45 to 50% more than they actually are, right?
And by the way, that's before taxes and fees,
and everything else. Yeah,
absolutely. So before all of those things, so when a client comes to me, and we've had, like I said, we've had some great sales. We've had some sales that didn't work out as they had liked. And really what it came down to is planning. The ones who are successful plan far in advance. They have their vision board. They have their roadmap. The ones who don't, who get that letter of intent and sign, their sale usually goes a little rocky. We can get it through the finish line, but we're going to get it through the finish line at a lot lower value. And they're going to give up a lot more than they thought, right, in that process. And a lot of times they end up having to work more years after because they thought they were in this place that they weren't there, right? They weren't where they thought they would be financially.
Yeah, to get a higher dollar, it required them to stay longer.
It stay longer or go get a separate job if they've sold their business and now they can't work in the industry because they have a non-compete, right? Mm-hmm. Depending on the business. And specifically for physicians, a lot of times, part of that sale is how long you have to work after. So if we have a physician practice that he really wants to be out in 3 years and we haven't started planning 6 years in advance, like truly planning, we're going to be late to the finish line here. Mm-hmm. So being able to talk about that and knowing too that you have options, because not all sales are going to be private equity, right? We know that 40% of businesses in the next 5 to 6 years want to sell. We know that, right?
Mm-hmm.
We know that there are 34 million small businesses today.
Yes. Yeah.
40% of those want to sell.
Yep.
And that's only going to grow. And only 35% of those are actually going to sell.
Yep.
So there's a huge disparity in those who can sell, who think they can sell, and those who actually will sell.
Yeah.
And part of that, if you're not talking to your CPA and you're planning and you're not talking to your financial advisors and there is no roadmap, you're going to be in a position where you thought you were worth 10 million and you're worth 2. Well, how do I leverage that, right?
Yeah.
So that's really an important
Well,
one.
I think it's great, and it kind of reminds me of this book I'm reading. It's here in the studio, ironically, Outlive, Peter Adia. I apologize if I'm butchering that, but Dr. Adia was a surgeon, and he came to this realization in the medical field that all the cases that he was treating were completely reactionary.
Right.
How can I help this cancer now that it's already occurred? How can I fix this broken bone now that it's already happened? Mm-hmm. And he started to think, what can we do on the front end to kind of prepare the body, prepare ourselves to where these risks are mitigated, and we might not have to treat the cancer or the broken bone because we've done work on the forefront to prepare for that. And what you're saying is exactly the same thing,
right,
but just preparing for an exit. We're
actually going through a huge one currently, and we just finished up several. But part of what we do, right, when a company comes to us is we take a look at their financials. And generally what we're looking at is trend analysis. And part of that trend analysis is, do you have good systems in place, right? So usually when a client comes to us, they have systems, but they don't have a systemized, especially back office approach. So we'll go through that process with them.
What would be included in that back office system?
So making sure you're leveraging technology, right? Do you have the most up-to-date ERPs, EMR systems?
Yes, explain those.
ERP. So like your operation system, right? Your CRM, your client management systems, like your point of sale systems.
So the hub of client data.
The hub of client data, right. What companies forget is they like to keep these old systems because they're cheap. They're legacy systems. I have clients in Great Plains today, and most people probably don't know what that is, but if you do, you're aware of like how long it's been in the industry. Well, that's part of your value. So if you're investing in systems and systematizing something, that's going to increase your value, right? So the first thing we do is look at, what are your systems? Are you leveraging AI? Are you leveraging the components of your systems that you need to be successful? Or are you relying on staff, which costs a lot more money, right, to facilitate the things that could be systematized? So that's a key savings right there, right? When you start to look at your back office systems, and for medical practices, it's something like their billing management system that they use, right? So that's their EMR system. And does it integrate with their accounting system so that it's streamlined and easy to understand? But that works in all businesses. And what I think happens in small business is we kind of get, we'll take one little Band-Aid and put it on this system and take another Band-Aid and we'll hire somebody just to do this data entry. And what they forget is they're decreasing their value, right? Because the more overhead that occurs, the less value you have. And you also can't plug and play. If you're an entrepreneur or an investor, you don't necessarily want to run a printing company or a flooring company. What you want to do is invest in the systems and the people behind that system, right? If you don't have good systems to start out with, what are they investing in? Old legacy systems that now they have to go and convert. Do they really want to be doing that? And what we found is that decreases their value. So step one for us is looking at your systems, your internal processes, and saying, what do you need to upgrade? How do you need to leverage AI? What have you done already? What are your goals, right? What are those systematic goals?
And so the purpose of that, what you're saying takes me back. My parents owned and operated an optometry practice for a long time. I remember when they had paper files everywhere.
And they still do.
I
would say 70% of small business are still operating on old legacy systems where there's somebody's still printing checks. If you're doing that, please stop. If you're listening, there are free things out there to make you not have to do that anymore. And honestly, it will make you worth so much more money to pay that $10 or $30 a month to get a system that works.
And the point is it helps reduce margin in the long run.
Exactly.
Increase efficiency, which talk a little bit about how, and I want to get back to the story, but talk a little bit about how businesses most of the time are valued as a multiple of EBITDA. What is EBITDA, and why is increasing efficiency and margin important when a business is looking to prepare for a sale?
So when this happens a lot, for sure, clients will come and say, what's my EBITDA? They don't necessarily know what that is, but it's just your earnings before interest, taxes, depreciation, right? And what that number does, right, is to help the investor understand, what is my cash flow? What is the true cash flow, right, at the end of the day?
What they can extract out of that business if they buy it.
That's right. What can they extract in the long run? They may not be able to extract it today because you have assets you're purchasing. They're, cash flow, things of that nature. There are taxes, but your taxes are your burden, not theirs. So they're not factoring in the tax or interest, right, for the loans.
Right.
So that helps them understand how you're flowing. And when these businesses are looking at that, one of the things they need to understand is every component, all these tax savings that you want to do, like you want to buy that truck on Instagram or whatever, TikTok, that go buy that big SUV and write it off. You 100% can, but you need to be aware that everything you do that's not necessary to run that business is going to impact your value over time, right?
Sure.
So it's important when you're talking to your accountant not to just focus on tax, because we have a tax CPA and he's fantastic, but he doesn't make a decision without talking to me if it's one of our advisory clients, because he's looking at it from a tax savings opportunity. He doesn't care what your value is. Like, he's not looking at it from that perspective.
Which have two different goals.
Two different goals. Yep. Two completely different goals.
Tax mitigation, cash flow generation is completely different from valuation.
Totally different.
That's one of the, we talk about this, we do presentations, and that's one of the first pitfalls first common mistakes that business owners do, is that they're so focused on not paying their tax.
But are.
That affects, if you're going to sell, that significantly affects the valuation.
It significantly affects the valuation. And I'm not saying you can't do both, right? But there has to be a business reason to take on debt for yourself. I mean, even in what you guys do with helping clients, same thing. You don't want to go buy a house. I have an example of this right now. So I have a client who came to us, and great client, love them. They're fantastic. But one of the things they were trying to figure out is, do I expand my operations or do I go buy a piece of land for $750,000, right? And so we're talking through that process. And I said, well, let's think about it from this perspective. You want to go buy a piece of land or write it off, which land is not deductible, but that's the plan. You want to build something on it. You want to depreciate it. Fine. But what are you going to use it for? And he's like, well, mixed use. I'm going to go take my family down there. We're going to camp. And I was like, okay, that sounds fantastic. Let's look at your vision board. Is this part of our vision plan, right? Well, no, but somebody told me it was a great idea and it will be valuable over time. And I said, not disputing that, but let's think through this, right? You took that same $750,000 and you invested in your systems in your business today. And you added management staff, so that you could step away from your business. What do you think that value would be, right? So let's talk about that, because you only have so much money you can go to the bank and borrow, right? Especially in this environment. So if we're going to go borrow, are we going to go borrow for this life plan, which is fantastic? I love life plans. I support that, but there has to be balance to this process.
Right.
Or do you want to invest in the business like we discussed over the past 3 years, and it's going to be worth 4 to 5 times more, right? Let's talk about that. So at the end of the day, being able to have those conversations with clients, and we don't say, no, don't go do that. We say, let's look at this. What's going to fit your vision board moving forward, right? So I think that's really the key conversation. But then we look at it from a tax perspective of, okay, you could write off so much more if you invested that $750 in the business today, right? That's the other component. Now we're saving cash flow, which we want cash to go reinvest or to take it out, right? Because we want you to get paid for the work that you do, because you are working every day, and we want you to get a really good salary.
Which that $750 invested into the business, you extrapolate that over a couple of years, that should turn into 2 to 3x more versus the land probably.
I mean,
is
it's
not
going to go
gonna do
up,
that. It'll go up,
but how much are you going to have to put on top of that, right?
Right.
'Cause you have a piece of land for $750, which is again fantastic. I love real estate. There's definitely value there to diversify your portfolio.
Sure.
But if we're thinking about every dollar, let's think about, is this really going to create the mission and vision that you plan for yourself? And if it is, fantastic, let's do it. If it's not, let's look at how do we take that same $750, reinvest it, and get a 4 to 5 time multiple and cash today, because you're not paying that tax in, right? Because we're going to find ways to leverage that to make as many write-offs as we can in that process.
I think what you said is beautiful, especially when it comes to just advisory and advising, because you're not saying, no, don't do this. You're truly a partner in the conversation of educating and saying, listen, if you do this, these are the ramifications. If you go this route, this could be the potential opportunities. At the end of the day, it's your decision, it's your money,
Right.
but I'm just here as another voice in the room of somebody who sat through this and helped other business owners do the same thing. And so I want to go back in that same sense. You talk about the first thing that you do is really step in, help advise on the more operations. How can we become more efficient? How can we increase margin? What is the next step of an advisory relationship?
So the next step is really creating a financial story,
Okay.
a business story.
Okay.
What we forget as entrepreneurs is we know our passion, right? We love our business. We founded it. We think it's our baby, right?
Right.
But not everybody else is going to have that same passion, love for your business, right? So when they look at it, they're going to see an option to invest, or you're going to want to bring employees into that love, right? Because there are other ways to sell that don't include PE, which actually works a lot better for a lot of businesses, right? PE is probably 10 to 12% of all business sales. So we're looking at the dashboard, the story. What's our roadmap? So let's roadmap it through the next 3 to 5 years. How many employees do we need? How do we create less reliance on the business owner, right? So
Reduce owner dependency.
owner dependency. What is it that you're doing today that you need to shift off to someone else, right? So I'm an entrepreneurial organization. I don't know if you guys know that, but that group, but a lot of what they do is talk about those things, right? So they talk about, well, what can you systematize to create a path that less owner dependence? And when we create that, that's where our value grows too, right? It's not just about, I'm going to get my systems in place. I'm going to have, good, clean records. That's super important though. We look at the accounting records. We say to the client, you were running checks manually. Let's get it into a system so everything's automated so that your bills show up and there's an audit trail, right? For everything that you've done. No, it's not sitting in a desk drawer. Nobody wants to go look in your desk drawer to find what you paid bills last month. That's not how quality of earnings works.
Yeah.
They don't want to do work. PE likes to get in and get out, right? They want to go on to the next deal. So you have to make your systems make sense. So part of that is looking at those things and having those conversations and then sketching out this roadmap with them and then really getting into where are we going to be? So what's our plan for the next 6 months? Let's meet those strategic goals.
We love mini sprints. Focus on one thing.
That's right. Mini sprints. Next 6 months, we're going to change our financial statement accounting from cash to accrual, right?
Yep.
Because we need to understand debt and we need to understand prepaids and we need to do that for 3 or 4 years. What you don't want to do is change your accounting records 6 months before you sell. You decided to go from cash to accrual. That is bad.
Yeah, because then your
There's no
past
trend.
Years, there's no trend.
There's no trend.
And that's a red flag for a buyer.
100. They just can't even, their mind gets blown and they can't even comprehend what's happening. So they just
It's two
back
different
out.
sets of books.
Yeah, and they can't, most PE firms are not accountants. So they're coming in from an investment strategy. They do have really good CPAs that they hire. But at the end of the day, they need to understand it and they don't always understand exactly what's happening. So we got to make it as simple as possible for the reader. That's what I always say. You're telling your story to someone else who has never understood. I love Lucy Liu who works for me, but she may not be the fastest person or she may not be the most effective, but Susie's been here forever. She's great for the team, right? You have to tell that story on paper. Why is Susie relevant to your practice or to your company? So we tell those stories, right? And then we get into really strategic advising, cash flow forecasting, because cash flow is what really values your company. If it's bringing in cash more than you're paying out, somebody's looking at that and they see that as attractive. They want to, they're like, hey, knock, knock, knock. You start getting those phone calls left and right. And that's why healthcare is such a commodity, right? Physicians go in and they operate and they do what they do so passionately and so well. And it's amazing. But then somebody knocks on their door, just like my client, at $6 million, somebody knocked on his door. That was his value, $6 million. And he thought he was worth 12. So we did when we start with a client, we always do a valuation on the front end, like a very non-certified valuation, but just something where they have an understanding of what they look like. So we're like, okay, well, you're really worth 6, but we can get you to 10. We need about 4 to 5 years, right, to get this in line. He's like, that's fine. I'm 10 years away from retirement. So if we start today, 5 years from now, I'll be ready. So we went through this whole process. We told his story. We got his surgery cases organized. We have his back billing, making sure that was happening. 4 years later, he gets a knock on the door, and we're ready. Like, we have everything ready. And he knows now that he's worth 10 or 11. So when they knock on his door, they offer him 8.
No.
And he's like, no.
Yeah.
I know I'm worth 10 because I've been working with Tina.
Yeah.
And I have all of my
Your ducks in a row.
information.
Everything's good.
Got everything ready to go. And so
but what that also tells you too is if someone comes and knocks on the door and offers 15, you say, "Okay, let me think about it." And then within 24 hours you say yes.
Yes.
Because you know that it's fairly valued at 10 or 11, but if you get a 30% more offer, go ahead and take it.
You can see the whole picture.
Well, I don't know.
Okay, tell us.
Okay, I don't know if I agree with that. And the reason is the person that's buying your business, you have to like. And that's what people forget. They see numbers and they see, okay, 15 million, 24 hours, I'm signing this LOI. I'm so excited. It does not matter, right? What I found is the opposite occurs. We will go through a sale. They've signed, they've done all these things, they've gotten higher value than they expected. There's strings attached to that value. So what's happening here? Why are they giving you 15? Are they really giving you 15? They're probably not. I think they're probably giving you about 60% cash and about 20% stock and 20% rollover in a company that may or may not be worth something.
May or may not succeed.
Exactly, in the future.
That's fair.
So I'm the opposite. I'm like, no.
That's a red flag.
Yeah. You want to offer me 15 tomorrow? That's great. I'm ready to talk. I've got my ducks in a row. You bring to me the table, the offer that you have in your LOI. No, I'm not signing that LOI because I'm going to go research your company. I'm going to get to know your culture. What are you about? How many sales have you had in the past that have been successful? And I want to talk to 10 of the people that you sold to, not 2, because 2 people, they pay to tell them. They 100% do. PE pays the other doctors to tell you that things are great, even if they work, right?
Yeah.
So I want to talk to some of the employees. I want to talk to some other people that you have been a part of.
Do your due diligence on the buyer.
You absolutely have to do your due diligence.
People forget that it's an interview both ways.
Yep.
Definitely an interview both ways. It never happens, hardly ever, in any sale where a client signed an LOI. I'm like, well, tell me about your buyer. I have no idea. Like, wait. You don't know anything about them. What's their background? What are their mission and vision goals? Why do they want your company? What are they going to do? Are they going to break it down? What's their plan for your company? Why do they want it, right? And so,
are you going to become an employee for the next 3 years?
Are you going to work for 6? And I wanted to work for 3.
Yeah.
So
I met a doctor who was going to be required to work for 10 post-sale.
That's wild.
Yeah. Did not accept the offer. But
Yeah.
Exactly.
Yeah.
I mean, so those 24 to 48 hour ones are probably the most sleazy ones out there because they are just like, they're not coming to you with the diligence on their side. So they're coming after something. What are they coming after, right?
Well, speaking, I think this is a good opportunity because we did want to dive into private equity.
Yeah.
And so I know they're only 10 to 12% of what you've seen. And so, but it is kind of all the rage. They're coming into middle America and they're buying up as much to do a big roll up. Well, can you walk with us through why an owner or what an owner should know before considering an offer from PE?
Yeah, so I think PE's awesome opportunity. I mean, there are so many reasons that PE can be so successful. So generally when a private equity firm or or a private investment. I kind of consider them both similar, right? Maybe private investment is a little more family office oriented.
Yeah.
But when we look at that, PE walks in the door. What you need to know is that's great that you have the opportunity with them, but what are they asking of you? And what is your non-compete for the area, right, that you're in? And when you can get those things in line and you're in a place where you can step away emotionally from the business and say, PE is going to come in and they're going to run that back office, and I'm going to be okay with all the decisions that they've made because I know I've built a practice or a business to sell in 5 years, and it's been on a roadmap that these PE firms are going to come in, and I've built it in a way that I'm comfortable when they come in and take over the management of the company, right? Because that's the intent of that process. But usually with PE, there is a multiple, right? They're coming after a multiple for 5 to 6, depending on the industry. It can go up to 8. Currently, PE, there's less PE acquisition due to interest rates than we've seen in the past. So currently, in my opinion, now is a good time if you're interested in PE to start those conversations, getting those books ready, right? Starting to look at what is your value, what do you think it is, versus where do you want it to go? And looking at those systematized approaches to come in so that when you're talking with private equity, you have those systems in place where they can plug and play. So if they can plug and play, that's going to make you more valuable. And usually in PE, in healthcare, you have to work 3 to 5 years, sometimes 6, sometimes 10, apparently. But in other businesses, you can actually exit pretty quickly, right? 6 months to a year in certain situations. So being prepared for what's next in your heart is also a big component of that. Because we do see owner's remorse, or owner's remorse really for the sale.
We know, 74% of all business owners that exit regret selling a year after their sale. And most of it isn't monetary, right?
Oh, it's never monetary.
It's all,
it's regret.
It's regret
of like, how am I going to spend my time? What's my passion? And your internal clock. It's like you're used to running at 100 miles an hour, and then now you're in the slow lane. Like if you're a fast,
purpose?
Yeah. What's your purpose?
You're
used to running at, a super fast speed, and then now you don't really have that to do. You're going to start making mountains out of anthills that you start solving problems you shouldn't be solving at home or wherever. And no, it's true. Usually a year after, you forget about them. If you even say private equity came in with $15 million and you were worth 10, and we did all the due diligence and it was fantastic opportunity and you took it, right? We did our tax planning strategies. You got $10 million in cash. You're sitting there happy. A year later, you're like, what's my life looking like now? What's my plan? So you can't just plan for the sale. You have to plan what's after the sale. After the sale, yeah.
And what does that look like for you? And what are your new hobbies? What are your new skill sets that you're going to have? Are you going to start teaching or training or podcasting, or what does that look like, right, for you? But the other thing that we see a lot when we talk about regret is a lot of these companies, these small business owners realize that if they had kept the business and planned for an internal exit versus a private equity exit, they actually could have gotten more revenue out of that, more value out of the company, and they still have holistic control to some degree, right?
Why is that, Tina? How are they able to extract more revenue?
So a lot of times what you can do, you can value your company through something called an employee stock ownership plan. ESOP.
Yes.
So not every business, it makes sense, but in a lot of businesses, you can, I have 3 or 4 clients right now in an ESOP program where we looked at their situation. They didn't want to sell to private equity. It just wasn't the right type of business. They had a culture they wanted to maintain. They didn't want to let Susie go in the future because they love Susie. Yeah. And they knew that there was an opportunity if somebody new came in that they would really re-strategize. They would get rid of a lot of the back office. And there was an owner there who just felt passionate about keeping the culture that he had maintained. So part of that is when you have a really good team, and that's what you want to build, right? Internally, you want to build these systems and systematize as much as you can. Part of that is a really good management team, and he wanted to reward them. So you can get your company valued, and it's a lot easier for you to value your own company higher than a private equity company is going to come in and value, right? So when you do that, employees can buy into that value with stock. So every year that earnings and profit is happening, you're getting paid for all the work that the staff is doing, but they're also getting stock ownership in the company. So you're still able to maintain control, right? Most of our ESOP owners are no longer active direct in the business, but they're drawing that monthly payment every month.
Yeah.
And that's their value, right?
There's some IRS tax incentives to do that too.
Huge
because
tax
you're keeping
savings.
everything kind of the same. It doesn't disrupt the business, but both the buyers and the sellers, both participants in the ESOP and the owners, they both get some tax benefits of doing that.
Yeah, it becomes like almost like a 401k. You can think of it like a 401k program, where the company is no longer taxable as its entity level, which is a huge opportunity, right? And we think of big companies, finding ways to mitigate that tax. That's a huge opportunity where, number one, you get to keep the culture. You don't have to go out and find a buyer. Because we know that those are few and far between, generally speaking. Now you can actually look at your internal team and say, I'm building a team today that I want to hire the right people who want to buy in to the company. And that's part of our initial strategy sessions, right? We're saying, well, let's look at these things. These are your options. You have PE, you have selling to family members. We have a lot of people who keep it in the family. Then we have selling to your employees. And then we'll have something like selling to associates for physicians who want to bring in partners. So you have those 4 paths, and we educate on these 4 paths. And then at some point we decide as a team, this is going to be your best path, right? One of these 4 strategies. For today, like we have clients that pick the private equity, and we go down that path and we plan for that. But then we have the ESOP path, right? Where it's like, no, I've built a management team, and we're going to keep building that management team, and we're going to revalue. And the day that you're ready to exit, 8 years in, as long as you've got your systems in place, you can still come in and still be that leader, still be valued in the company. You don't necessarily have to step fully away, but you could be coming in 2 days a week or 1 day a month, and still be drawing that check from that ESOP and getting a bulk payment up front that you have for that investment. So
that's important too for like management retention, things like that, because you're almost like reverse engineering a pension, because our parents, they all retired with pensions and things like that, or grandparents. That's not really how companies are doing it nowadays. But an ESOP program would be a really good way to kind of reverse engineer that and create a retirement for everyone.
Well, yeah, I mean,
it's owned by the business.
Yeah, I'll just speak
for that owns the business.
My wife's company about a year ago turned into an ESOP, and we had our 3rd child a couple of months ago, and she stepped away from her job, and we got a rollover check because of the ESOP. And it's exactly what Steve was talking about. There was nothing active on what we did, right? It was all just the management team and the owners saying, we want the employees to participate in this, and my wife was able to benefit. And so I want to take a turn now, and you mentioned tax strategies, and ESOP is certainly a strategy that you can utilize. Talk through a few tax strategies owners can implement based on their situation, but also some big tax downfalls that you see some owners kind of step into that could be mitigated with an advisory relationship 3, 5, 6 years before they sell their business.
Yeah, so I think the biggest thing that clients forget in the tax strategy, right, is that it's not about saving today necessarily, it's about saving over the long term. So making a strategy that's more about 5-10 years down the line when it comes to tax versus today. So obviously there are things you can do today, like looking at 1202 stock, which is a stock where you can become a C corporation 5 years prior to selling, and that gives you an equitable option when it comes to selling your business. You would get a lot more capital gain opportunity, which is what clients come to us, and they all think they're going to get capital gains because the neighbor told them down the street that if they sell their business, it's going to be all cap gain. That is not the case, right?
And 1202 is qualified small business stock,
That's
correct?
right. Yeah.
Okay.
So 1202 is qualified small business stock.
But it has to be a corporation.
Has to be a corporation.
C Corp.
Yep,
Yes.
has to be a C Corp. Yes. And you have to have it the election 5 years prior to sale, which is why
Right.
I said you're
Yeah.
planning for exit without selling, because you cannot plan 2 years before the sale and say, I
Yeah.
decided I wanted to do 1202 stock and I apply. I definitely meet the criteria. So if you haven't had those conversations with your CPA, my suggestion is to have those conversations, because not all businesses qualify. Healthcare does not. Accountants are always out of the opportunity.
We're the same way.
Financial advisors.
Professional services, I think, don't.
I don't know
no professional
why
services.
we are just the hated IRS group of people.
Yeah.
But me and my tax partner, Sean, talk about that all the time. I'm like, I don't know what we did to government, but we really need new lobbyists or something, because we
Yeah.
keep getting excluded from
It's because you
these.
save your clients so much money on
I
taxes.
guess
They're saying, hey, you're going to pay us. You're going to make this up.
I guess so, but it's hilarious. But looking at those types of things and figuring out,
Because if you do qualify for something like that, it's a lot of tax savings.
huge,
Yeah.
like hundreds of thousands of dollars in
Yeah.
opportunity. And so that's a really key point, that's an opportunity. Looking at your structure of your sale also is a huge opportunity, where maybe it's an installment sale agreement where you don't get as much cash up front, but you get it kind of leveraged over a period of time. That can be both good and bad. And we kind of talked through the pros and cons as we're looking at each deal. Because obviously more money in the pocket today is better than money in the pocket tomorrow. But
Because you can invest it.
But they might not
grow
have it. They might not have cash flow in 3 years because of a bad decision that they made.
Exactly.
And so you're not guaranteed. I mean, even though they signed an agreement,
that's right.
cash today is worth way more than cash in 3 years.
Totally agree with that. But when it comes to tax strategy, having an installment sale and a good interest rate where they're paying you back over that installment sale can actually benefit, and you can leverage it in certain opportunities, right?
And the reason for that would be because you're not getting it all in one bucket. You're spreading it out over the course of 3, 5, 10 years. You might be in a lower tax bracket each year, which increases your take-home pay, correct?
Correct. That's right. So we see this a lot too with people who withdraw money from their 401k, which I never suggest. I just had this last week where an employee of one of our company clients called and said, hey, my employee owes a bunch of tax dollars and he's so confused. And he withdrew money from his 401k ESOP early. And so that pushed him into a 30%, 35% tax bracket, and he's normally in a 12% tax bracket. Well, that's a huge difference in tax, right? So looking at that to say, at what point would that push you into a tax bracket that's going to be your highest tax bracket? And is there a way that we can kind of smooth that out where you're paying the least amount of tax possible over the period of time?
Talk a little bit about the difference between an asset-based sale and a stock-based sale when it comes to exiting your business.
Yeah. So generally, most businesses are going to be an asset sale, usually because the buyer requires that. It's better for the small business if it's stock sale. So if you can make your stock valuable, that is always the best way to go from a tax strategy perspective.
Because most of the time, that's just a long-term capital gain,
That's right.
correct?
Correct. But what we see in small business or in this structure is that most businesses do not want a stock sale. Most private equity, especially, depending on if you're Apple or something, there are exceptions to the rule there, obviously. But generally, what they want to do is they want to buy the company assets, and that's the intangible assets, which is your staff, your team, your IP, all of your systems. But they don't want to buy the liability of the company. And if they keep your company and you owe back taxes, which is always bad, please don't do that. If you're getting ready to sell your business, make sure all your taxes are current, both state and local. You've paid all your sales tax, because that can be a huge red flag, right, for the viability of the business. But they do all that work, and then someone comes to them and says, well, I want to buy all the assets of the business. Well, that means for that client that they're going to have something called depreciation recapture. So if they're buying all your trucks, your vehicles, your medical equipment, that is ordinary income to you, recapture. And that's what clients forget because they think they're going to be in that 15% tax bracket. Well, really, a lot of their sales is going to be in that 39% tax bracket.
Because they've depreciated all those assets. Now they have to recapture that.
That's right.
And then the buyer gets to write it back down.
That's what they want,
That's
right?
what they want, yeah.
The buyer wants the tax deduction now so that they have cash flow to put back into the business today, right? So if you've already depreciated down all of those assets and you have that depreciation recapture, and it's an asset sale, if you have two options on the table and both buyers are great and you've done their research, you always want to try to go to that stock sale over that asset sale if at all possible, right? If all deals are the same.
Yeah.
And then now it is up to the buyer. So you're going to have to negotiate and you're going to have to know in advance what you're willing to do there. Which is another conversation. When a deal comes in and they want to give you $15 million, is that an asset sale or is it a stock sale? Let's look at that, right?
Are there scenarios where it's a combination of both?
No. Not usually. I have not seen that.
Yeah.
So usually it's one or the other, because they either have to buy the assets, right?
Yeah.
Or they buy the stock. They can't buy both, because in essence the assets are the stock. At the end of the day, that's what values the stock. But usually what will happen is they will have that asset sale. And what we do, how we help mitigate that risk is we take it on our team to go through the fair market value assessment of the assets. And I can tell you our value for assets is going to be very different than their fair market value of assets, right? We do our due diligence, obviously, and make sure it's fair market. But we're always going to go on the lower side of fair market where they're going to go on the higher side of fair market value. So if you don't have your CPA involved at that sale time, you are going to be in a situation where you're missing out on very important strategy opportunities that happen if they're giving the CPA the asset values. And
you don't want their CPA driving the deal.
No, you do not want their CPA driving the deal. You want your CPA communicating, working effectively with their accounting team to drive that deal where it's equitable for both sides. We're not going to try to take advantage of your potential partner. And people forget that. They're like, I want to get my deal. I'm like, this is your partner. Remember, you are now best friends with this guy. You've married this PE firm in some way, shape, or form, right? Or you've married this ESOP. So together, you have to work equitably. And usually, we'll save about 25% by just going through the process of where we're giving the numbers that make sense, right? Versus the client or the CPA from the purchasing entity.
Everything you're saying just drives home, to me, the need to have just a really, really solid team in place well before you even think about exiting. And you've talked about it all day, but having your CPA be involved in this planning before, just in general business planning, right? Not 3, 4, 5 years, having your financial advisor on the, sitting in the meetings, helping provide advice on if you take this net amount, is it going to be enough for you to do what you want to do post-exit? Having a good contract attorney, being able to iron out and make sure that the devil's always in the details, right? And I think you spoke really well to that. I've got 2 more questions for you. I'll ask this one and then I'll let Steve handle the last one. What is one lasting idea you would leave with a business owner who is not quite ready to sell yet, but is thinking about it within the next 10 years?
Thinking about it in the next 10 years, start your roadmap. Start building your company based on your vision board. Have a vision board separate for your company of where you want it to be. Because once you have it established, find a CPA that shares in that mission. If they're not willing to look at your deck, don't talk to them.
And I would say, to clarify, a CPA that can strategize.
Absolutely.
That can offer strategy services.
Yeah. A CPA that walks alongside you, right? That understands your business, that understands the lingo in your business.
That can look forward.
That can look forward, that can sit down with you and say, I see your vision. I want to help you get there. But don't leave the most important people, your retirement planners, your investment advisors, out of the room. I think the biggest thing that we see with clients is they get so focused on, I'm going to save $1 here, that they forget they're giving up $10 in the future.
That's wise.
And, you know, if you're paying your accountant 1.5 of revenue, 1.5 times revenue, that's pretty standard market. If you're going above that, you know, like a two times revenue or 2% of revenue, that gets a little on the higher side where you're getting that advisory role. So understanding that it's okay to pay for accounting services because it's going to lead to higher returns in the future. But knowing that accountant has to understand who you are, where you want to be, look at that vision with you, and strategize for the future. And beyond that, making sure that what you're investing in today for your business and your personal, right, your personal life does directly impact your value. So if you're living an extravagant life, which I support wholeheartedly, understand that your business you cannot drain your company cash flow to live that extravagant life and still have value at the end of the day. You are using that value today to live a life that maybe your company can't even sustain. Because we see that a lot with physicians, right? Where they have kind of drained the company every year out of all the cash that it had available to them, and they weren't able to reinvest in that company to build the true wealth, right, that they needed to create. So being able to understand that you have to have balance between your home life and your work life, right? From a strategy perspective, but from a financial perspective.
Yeah, that's good.
Yeah,
that's good. Well, I've got two questions for you. If someone wanted to utilize your services, how can they find you?
They can visit our website, mmascpa.com, and we are more than happy to strategize with them. We always start with a conversation about road mapping and then also about building value. So,
good.
Yeah.
Are you only in Tennessee, or could you work with clients
we work
all over the country?
Yeah, so we work with clients all over the country. What we focus on is, do they share the same values that we share, right?
Yeah.
Are they aligned? Are they bought into the concept of you're building today for something tomorrow? Because sometimes we all get stuck in instant gratification. And while that is very important, we want everyone to have that as much instant gratification as we can. We're really looking at, how do you see that future? How do we get there together, right?
Yeah. Mm-hmm. And last question. So this is going to be the last time that you'll ever have ice cream.
Oh my gosh.
What flavor? Where is it from? What are we having?
Okay, so this is kind of a funny question because I'm lactose intolerant and I never eat ice cream.
But if you could.
But if I could and it was my last day, it would be like chocolate with every possible topping with marshmallows for sure. Like mini marshmallows.
Yeah.
Like definitely.
The works Rocky Road with marshmallows.
Yeah. With
you
extra
want nuts and peanut butter and brownies?
All of it.
All of it.
Literally all of it, because
I
am a chocoholic. So anything that would allow me to have that is fantastic.
I can relate with that.
Yeah. Well, that would be good ice cream. Yeah. Tina, thank you so much.
Thanks, Tina.
Thank you so much for your time. I really enjoyed it.
Yeah, this was fun.
Yeah, thanks.
Yeah, thanks.